The stock market operates as a dynamic ecosystem driven by two key psychological and strategic forces, bulls and bears. These terms symbolize opposing market sentiments and behaviors that shape the direction of stock prices, investor confidence, and broader market trends. Understanding the concepts of bulls and bears, along with their implications, provides critical insights into market operations and investment strategies. Bulls in the stock market. Bulls represent optimism and confidence in the market. A bull market refers to a period where stock prices are rising, typically sustained by strong economic growth, high corporate earnings, or favorable government policies. Investors with a bullish outlook believe that prices will continue to rise, driving them to buy stocks in anticipation of future gains. This confidence often leads to higher trading volumes and increased liquidity, which further fuels upward momentum. In a bull market, various sectors may perform differently, with cyclical industries such as technology, consumer discretionary, and financial services often leading the charge. The optimism in such markets creates a positive feedback loop. As prices rise, more investors enter the market, pushing prices even higher. This trend can also spill over into other asset classes like commodities or cryptocurrencies as investors seek higher returns. Historically, bull markets have been associated with periods of economic prosperity, low unemployment, and steady GDP growth. For example, the bull market that began after the 2008 financial crisis and lasted until early 2020 was one of the longest in history, driven by technological innovation, accommodative monetary policies, and sustained corporate profitability. Bears in the stock market. In contrast, bears embody pessimism and caution. A bear market occurs when stock prices decline by 20% or more from recent highs, often triggered by economic slowdowns, rising interest rates, geopolitical instability, or external shocks like pandemics. Bearish investors believe that prices will continue to fall, prompting them to sell their holdings or adopt strategies to profit from declining markets, such as short selling. Bear markets are characterized by reduced trading activity, lower liquidity, and a general atmosphere of fear and uncertainty. Investors tend to move towards safer assets like bonds, gold, or cash to preserve their capital. Defensive sectors such as utilities, healthcare, and consumer staples typically outperform during bear markets due to their relative stability and consistent demand. Examples of bear markets include the Great Depression of the 1930s, the dot-com bubble burst in the early 2000s, and the market crash during the COVID-19 pandemic in 2020. These periods are often marked by widespread economic disruption, high unemployment, and declining consumer confidence. Key differences between bulls and bears. 1. Market direction. Bulls push the market upward with rising prices, while bears drive it downward with declining prices. 2. Investor sentiment. Bulls are optimistic and confident, whereas bears are cautious and skeptical. 3. Investment strategies. Bullish investors focus on buying and holding stocks, while bearish investors may resort to short selling or hedging. 4. Economic indicators. Bull markets align with economic growth, low interest rates, and strong earnings, while bear markets coincide with economic contraction, high interest rates, and corporate underperformance. 5. Sector performance. Cyclical sectors excel in bull markets, whereas defensive sectors perform better during bear markets. Factors influencing bulls and bears. 1. Macroeconomic indicators, GDP growth, inflation rates, unemployment levels, and central bank policies significantly influence market sentiment. 2. Corporate performance. Earnings reports, revenue growth, and profitability affect investor confidence and stock valuations. 3. Global events. Wars, trade agreements, pandemics, and technological breakthroughs can shift market trends dramatically. 4. Investor psychology, herd behavior, fear of missing out, FOMO, and panic selling play a crucial role in shaping market dynamics. 5. Market valuations. Overvalued markets often signal the end of a bull run, while undervalued markets may present opportunities in bear phases. Strategies for navigating bulls and bears. 1. During a bull market, buy and hold. Investors purchase stocks and hold them long-term to capitalize on rising prices. Growth investing. Focus on high-growth companies with strong potential for earnings expansion. Sector rotation. Shift investments into outperforming sectors to maximize returns. Leverage. Some investors may use margin trading to amplify gains, though this carries higher risks. 2. During a bear market, defensive investing. Allocate funds to stable sectors like healthcare and utilities. Short selling. Profit from declining stock prices by borrowing and selling stocks with the intention of buying them back at lower prices. Hedging. Use options or other derivatives to protect portfolios from losses. Diversification. Spread investments across asset classes to mitigate risks. The interplay between bulls and bears markets are inherently cyclical, oscillating between bullish and bearish phases. These cycles are driven by a complex interplay of economic fundamentals, investor psychology, and external events. The transition from a bull to a bear market, and vice versa, is often gradual, marked by periods of volatility and uncertainty. Market corrections, which involve short-term declines of 10 to 20%, can occur even within bull markets, serving as a healthy reset for overvalued conditions. Similarly, bear markets may witness brief rallies known as dead cat bounces before resuming their downward trajectory. Successful investors understand the importance of adapting to changing market conditions. While bull markets offer opportunities for significant gains, bear markets test resilience and strategic planning. A long-term perspective combined with disciplined risk management can help investors navigate these cycles effectively. Conclusion. The tug-of-war between bulls and bears forms the backbone of stock market dynamics. While bulls thrive on optimism and drive markets upward, bears capitalize on caution and steer them downward. Both forces are essential for maintaining balance and efficiency in financial markets. By understanding the characteristics and strategies associated with each phase, investors can make informed decisions, capitalize on opportunities, and mitigate risks. Whether navigating the exuberance of a bull market or the challenges of a bear market, adaptability and a clear investment strategy remain paramount.